What's up, apes? Welcome back to the Daily Peels video stream / podcast of the day. My name is David. It is currently 9:04 p.m. on this beautiful Tuesday, July 2nd, 2024. We're coming at you a little bit later than usual here today because I had to take a several-hour break this afternoon to go cry in the corner of my apartment because I just found out that both of the offers that myself and my girlfriend had out on houses both just fell through, despite the fact that we had offered more than 10% over asking on both of those. So it just goes to show you how fucked the housing market is, especially up in the Northeast. Well, let's go ahead and talk about something that you guys care about here, and that is, of course, going to be markets. We're talking everything markets for this Tuesday, getting you ready for Wednesday before the break for the single greatest holiday in the entire world on Thursday, being Independence Day here in the United States. Just another reason I hate Great Britain, as if we needed another reason to do so. But nonetheless, the WSO Alpha portfolio is up 86 basis points for the session. We did outperform both the NASDAQ and the S&P 500. The NASDAQ was up about 84 basis points, whereas the S&P was closer to about 60 basis points. Tesla had a good day in particular. They were up about 10.2%. As you guys know, the WSO Alpha portfolio is balls deep in Tesla. It was one of our most recent research reports, so make sure to go subscribe to WSO Alpha if you want to stay in tune with all of our research. We're publishing one on a cannabis stock here this week, and we'll be following up at the end of the month with one on, I don't want to spoil it, but a big, let's call it a big cigarette / tobacco maker. So we're doing only fun companies lately. But still, Tesla's outperformance really carried us for the session. We did see some strong performance from other names like Airbnb and some of the other more recent additions. But like I said, go subscribe so that you can stay tuned with all of our gains, all of our losses, and bully us along the way. All right, let's go ahead and get into some of the banana bit stories for the session here. First and foremost, good news for Shari Redstone and everybody else at Paramount, because it seems like the Skydance merger is actually going to go through. Now, previously, common shareholders weren't too pleased with this, but the stock is up about 6% after hours, so it seems like they are finally in agreement to be sold to Skydance. All right, and then, there was a big problem going on with this banking app called Yada. So this is my reminder, this is my PSA to all of our wise apes out there. Do not put your money in something that calls itself a banking app. It is not a bank. So there is a big difference between banks and not banks, or quote-unquote banking apps. Something like SoFi is a nationally chartered bank, whereas others like Yada or Chime or Dave, these are not banks. These are banking apps. So if you put your money in them and they go out of business, you have no recourse. There's no FDIC insurance. You're probably going to get completely fucked over. So just be careful with your money and who you trust with your life savings. Anyway, much like addicts marrying other addicts, Warner Bros. Also has an offer in on Paramount Global. So it seems like that deal is kind of getting pushed to the side for the Skydance merger at this point. Now, the Skydance merger news did come later in the day. Warner Bros. With their fucking $40 billion in debt and Paramount with their $15 billion in debt, both larger than the market caps of both companies. Obviously, it seems like a match made in heaven. It's like if a heroin addict and a meth addict met up at a bar and they really hit it off. It's a great fitting. I mean, not for the rest of society, but hey, it's good for the two of them. Then finally, this is a bit of a spoiler for our first big stock mover of the day, but Rivian joined its big brother Tesla and absolutely smashing expectations on deliveries. So the electric vehicle startup was up big on the day. I don't know if I should be calling it a startup still, but nonetheless, I don't know what else to call it. Those cars are pretty sick though. Let's go ahead and move into our big story of the day. So for Macro Monkey, we were talking about J-Powell Speaks. Now, Mr. Jerome Powell was out fucking around in Portugal here this week. There's a big central banking conference going on out there. These central banking conferences tend to be held in the most beautiful places in the world, like Jackson Hole, Wyoming, Davos, Switzerland, and this time it was in a town called Sintra, Portugal, or Portugal, I believe is how they pronounce it over there. But so over in Sintra, Jerome Powell is spitting some game on inflation and interest rates. I don't blame them for hosting them in these places, however, because if I was being tortured, the absolute worst way I can imagine torture in the modern era is to have to sit at a central banking conference and listen to these fucking Muppets yap on and on about fucking monetary policy for hours on end. And that's coming from me with an economics degree, so I can't even imagine what the rest of us think of this stuff. So you definitely need something to distract you from all of this enormous bullshit. So I don't blame them for hosting them in these locations, but let's talk about what they actually discussed. So Powell was unusually candid in his remarks during the day because most of the time we have to translate quite a lot of Fed speak whenever J-Powell opens his mouth. Today it was relatively easy, and let me go ahead and just show you the results of the session right here. So this is probably the most important chart to look at from the session. what we can see is the change in interest rate probabilities or market implied interest rate probabilities for the level that the Fed funds rate will maintain at the end of 2024. And as we can see here, there wasn't a huge change, but the biggest change of all was an increase in expectations for 2 rate cuts by the end of the year. It's almost at a majority, but right now it's at 45.1%. It increased about 2% in response to Jay Powell's comments, which might not seem like much, but to wannabe homeowners like me, or really anybody who wants to buy anything on credit or using debt, that's a big deal, and we absolutely love to see it. So it's moving in the right direction in that sense. And so Powell's comments really, basically, let me go ahead and just read off some of the quotes that he mentioned here. So first and foremost, this was following comments made by ECB President Christine Lagarde, who was also on stage with Powell during this Q&A. So they were asking Lagarde why she felt that it was right for the ECB to cut rates, because they did cut rates in their past meeting. Then they followed up with Jerome Powell and said basically the opposite. Why haven't you cut rates? Some of the things that he said was, quote, inflation now shows signs of resuming its disinflationary trend. He then said, we've made quite a bit of progress in bringing inflation back down to our target, while the labor market has remained strong and growth has continued. And finally, he also mentioned, we want to be more confident that inflation is moving sustainably back down toward 2% before we start the process of, then he kind of stammered to the level of fucking Joe Biden for a quick second, before loosening policy. So essentially what he's saying is that we have made significant progress, which the entire time that anybody has asked Jay Powell or anybody else at the FOMC what they need to give them that confidence to cut rates, he usually says we need to have further progress, so we need to have more confidence. And that's exactly what the moderator of this discussion followed up with. They asked what would give Powell more confidence, and he said, quote, we've made a lot of progress. We just want to understand that the levels that we're seeing are a true reading on what is actually happening with underlying inflation. He then continued in saying, we want to be more confident because, and frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right. So he's basically saying everything is going well. Why would we change anything right now? The labor market is holding on strong. Growth is going well. Why would anything differ whatsoever? And this tracked well with what the Fed stated in their latest press conference. So this is the updated statement from May 1st to June 12th. This is just that first paragraph because it's really the only thing they changed, where it said a lack of further progress toward the committee's 2% inflation target. They changed that to modest further progress, and that tracked exactly with what Powell said here today. So that was a very good sign. It gave markets a lot of confidence in rate cuts coming sooner rather than later. So once again, it seems like everybody is getting on board with our lower for sooner narrative as opposed to this higher for longer bullshit going on. So once again, I stand by my theory that there's either going to be 0 or 2 rate cuts before the end of this year, because Jerome Powell is a man of action. We see this with the COVID response. You know, when shit was hitting the fan, what did he do? He printed fucking money like a hurricane prints raindrops. Like, he was just firing it out there. Like, and then we even saw this when he started to raise rates as well back in March of 2022. It was time to raise rates. What did he do? Fastest rate hiking cycle in modern American history. So this guy, it might take him a little bit longer to commit to things, but when he does commit to something, he goes hard. So he's either going to, not cut rates whatsoever, or when he does the rate cutting process, it's going to be a swift move back down to their targeted level. Now, whether that level is 3.5%, 4.5%, it's a question of what the terminal rate is going to be. Nobody really knows at that point. The market is pricing at about 4.1% for the terminal rate right now, which would imply at least like 4 or 5 rate cuts between now and whenever that terminal rate is realized. That's the basic story of the day, but we also got was an update on the labor market via the JOLTS report, and I think the coolest way to show it is with the labor market spider that the Atlanta Fed produces. I'm not going to explain this whole chart right here, but definitely click the link in the piece because it's very descriptive of what's going on in the labor market these days. Now, we'll get a full update on Friday, but it was a mixed report to say the very least. So we did see that openings and hiring increased, but so did firings at the same time. We also saw for the first time the ratio of job openings per unemployed person in the United States dropped to 1.22, which was the exact level that it was at in February of 2020. So we've kind of come full circle on this problem of an imbalanced labor market. We're right back to where we were before the pandemic started. So once again, that kind of gives further evidence to further cut rates, because we were actually raising rates at the end of 2018 and into 2019 prior to the pandemic. They were basically trying to bring it off close to the floor of like 1.5% to 2%. So in my view, this is further evidence to be cutting rates. Expect either 0 or 2 rate cuts by the end of this year. All right, let's move into some of the big stock movers of the day. First and foremost, we have Reddit. So although Reddit isn't necessarily a meme stock in and of itself, it's basically the only actually true beneficiary of meme stock mania besides Keith Gill and his family's bank accounts. The biggest beneficiary is Reddit. It's bringing more attention to the social media site because that's where all these discussions happen. More attention equals more ad dollars, whether that's, more volume, higher prices, whatever it may be. They are also, getting money thrown at them. Like fucking, they're dancing on a stripper pole for all of the data repository that they have and how that can be used to train and improve large language models going forward. Moving on down to our second stock mover of the day, we have Tesla up 10.2% for the session. Back-to-back days that Tesla is up over 6%. And today, it had an actual reason. It wasn't just pure speculation like it was yesterday, because the company finally released their Q2 delivery numbers. So, delivery numbers were expected to come in at 441,000. Instead, they came in at 443,956 total vehicles. The other good news is that there was a higher percentage of that total deliveries that are Tesla's more expensive cars, basically meaning the Model S and the Model X. And so that could be an improvement for margins going forward. We'll see when the company actually releases its earnings report, but it's a good indication, and that's probably why the stock was up an additional 10.2%, despite the 6.5% or so rise from Monday. Now, that delivery figure, about 444,000, is 4.8% lower than Q2 of 2023, but it is 14.8% higher than Q1 of this year, moving back in the right direction, plus the margin improvement. What's not to like about that? All right, let's get into some of the rotten stock movers of the day. Wasn't really any big news driving stocks lower, or at least anything that I thought was worth writing about. Now, we did see Logitech. It fell about 2.2%. This is one of probably the most boring tech company in the entire world, probably because it's based out of Europe and specifically Switzerland. But the stock sold off because they found out that their chairwoman, Miss Wendy Parker, is stepping down. This has got to be the biggest compliment that an employee or an executive of a company can receive when you're leaving the stock falls materially. Like that's huge. They're saying that Wendy Becker added 2.2% to the market cap of Logitech itself. Gotta love to see it. I mean, I would be hyped if I left Wall Street Oasis and the company went bankrupt, personally. Just kidding, Patrick. I promise that's not true. Anyway, let's move on into our final stock movers of the session. We were talking about big healthcare, specifically Novo Nordisk and Eli Lilly. For those of you that don't know, these are the 13th and the 10th largest companies in the entire world, respectively. Both of them are slinging obesity drugs like there's no tomorrow. Novo Nordisk sells Wegovy and much more popularly Ozempic, whereas Eli Lilly's biggest one is Mounjaro. And basically, Senator Bernie Sanders and some intern that works for Joe Biden are extremely upset about the prices that these companies are charging for these obesity and diabetes drugs. They penned an open letter or an op-ed in USA Today that was released yesterday on Tuesday. And they basically said, you were charging unconscionable prices for these weight loss / diabetes drugs. Obviously, we know Joe Biden can't fucking speak on his own, so he definitely can't write as well. But nonetheless, he did sign his name to the document, or, he used whatever stamp he has to use that I'm sure fucking Jill or Kamala actually signs for him. But either way, Democrats are particularly upset about this stuff, so who's really, all that surprised? Basically, markets sold off Novo Nordisk by 1.7% and Eli Lilly by 0.8% on expectations that there could be like a price cap set on these drugs going forward. Right now, they charge an average of about $1,000 a month or so. And so we'll see if they can knock that down to like, I don't even know what they would do, like $300 a month or something. We'll see either way. Maybe just fucking eat healthy. That seems a lot cheaper than spending $1,000 a month on this shit. Anyway, let's move on into our final segment of the day. So we were talking about Thought Banana, and here we are shorting India. Now, my 401k is personally balls deep in India, so this is not necessarily my perspective. Remember, the views stated on this podcast do not necessarily represent the views of the person stating them or Wall Street Oasis itself. But anyway, imagine you caused a sell-off of $153 billion in a foreign country by shorting one stock, and as a cherry on top, you didn't even make any money off of it. That is exactly what Hindenburg did with their short of Adani Enterprises. So the other day, Hindenburg published an update because they are getting fondled by the Indian securities regulator. This is called SEBI, which is the Securities and Exchange Board, I believe. I forget what the I stands for, but either way, I don't have it written down here. Anyway, basically, SEBI, which is India's security regulator, once again, they sent Hindenburg a show cause notice, which is apparently basically a notice that says like, hey, we're coming after you. It's kind of like, it seems like their version of like a Wells notice, but effectively they're a little bit upset about stuff like this. So this is it's basically a little bit more than a 2-year chart of Adani Enterprises. This is going back towards, actually, yeah, it is about 2 years, July of 2022. And if we look right here, this is January of 2023 when Hindenburg published its short report on Adani. The stock fell from about 4,000 Indian rupees down to about 1,200 or so. So that's about a 70% loss in 5 minutes, basically, is kind of what they caused at this point. So obviously the Indian securities regulator aren't too happy about that. A year and a half later, they sent over notice to Hindenburg that, they could potentially be hit with some charges, pay some fines, or be issued like a cease and desist in the country of operation. Yes, foreign securities regulators can levy penalties on U.S. companies, whether they're hedge funds or anything else, based on violations within their jurisdiction. So SEBI would basically be saying, like, you are not... Like, it's a little bit weird as to what they're exactly saying, because they're not necessarily charging Hindenburg with any crimes or anything. They're basically just saying, like, hey, that was really mean. And we can see this in part of Hindenburg's response. So they said, SEBI show cause notice identified 0 factual inaccuracies with our Adani research. Basically, they say that the regulator took issue with things like the use of the word scandal, and their quoting of an individual that alleged SEBI is corrupt and working, quote, hands in gloves with conglomerates like Adani. So that's a big problem going on right now. Hindenburg is saying that this was fair. They didn't say anything knowingly misleading or false. Now, SEBI seems to be saying, like, hey, that was fucking rude, and I don't really see what the violation is right there. But nonetheless, that's where the situation stands right now. The craziest thing is that Hindenburg, after all this, didn't make any fucking money off of their short sale. So they basically said that after research costs, after legal fees, they're going to just about break even on this. In terms of total revenue, they somehow only made about $4.1 million, turning in about $31,000 in total profit. I don't exactly know how that could possibly be true based on, the shorts that they were putting on, but nonetheless, that is the data that Hindenburg is giving us right now. Fuck, I totally forgot to put a quote in here so far, so... yeah, I guess we'll just end it right there. I'm going to go through a quote in the actual edition, but for now, I guess we'll call it a day. Thank you all for joining me here once again. We will see you guys tomorrow, and we'll be wishing you a great 4th of July then as well. But for now, happy investing, happy trading. We'll see you guys tomorrow. Bye now.